I've been investing for nearly 5 years, and during that time, I've learned that there are 3 secrets to success as an investor: simplicity, consistency, and knowledge. I've crafted a 3-step long-term investing strategy that captures each of these critical success factors, and in this video, I'm sharing it with you. The beauty of this strategy is that it can be adopted by anyone in a matter of minutes. It requires virtually zero time commitment, and based on historical data, it's likely to outperform most other investing strategies, even those which have been implemented by investing professionals. This is how I'd invest my first €100 as a European investor. Step 1 is choosing the right broker. Your broker will act as the middleman between you, the investor, and the financial markets. Brokers are effectively the means by which you'll invest your money. Selecting the right broker is crucially important, and for this strategy, you'll need a broker that charges little to no fees and has a comprehensive investment selection. However, there are many online brokers serving European investors, and it can be difficult to know which broker is best, especially for beginners. Choose the wrong one and you could end up paying much more than you need to. There are 3 brokers that we'll be using for this strategy: Trading 212, Trade Republic, and DeGiro. While you can execute this strategy using just one broker, I recommend using all 3 simultaneously and splitting your investments between each broker. There are 3 main reasons why using multiple brokers is advisable. Firstly, you gain additional protection under EU legislation. Cash balances held with a European broker's partner banks are protected up to the value of €100,000. Your investments with the broker are protected up to the value of 90% or €20,000, whichever is lower. These protections are offered on a per financial institution basis. Therefore, the more brokers you use, the more protection you gain in the unlikely event of a collapse. Secondly, you become semi-insulated from fee changes. Broker fees can and do change over time. You might create an account with one broker that offers the lowest fees at a given point in time, but there's no guarantee that their fees will stay that low forever. The case in point example is the Dutch broker Book0. They went from being one of the cheapest brokers in Europe to charging their users €2.99 per month for simply having an account. If you find yourself in a situation where you want to pull your investments out of a particular broker, you normally have 2 options, neither of which are favorable. Option 1 is to sell your investments and close your account. This has tax implications where investments are sold at a gain and can result in financial loss if investments are sold at the wrong time. Option 2 is to transfer investments from one broker to another. Some brokers prohibit this altogether, and for those who allow it, they typically charge very high fees for doing so. So to avoid a situation where you're all in with one broker, fully at the mercy of their fees, it's wise to avail of multiple low-cost, high-quality brokers from day one. Finally, not all brokers offer access to all of the financial products that are available on the market. Having access to the most competitive investments at all times is a high priority for investors, especially those who are utilizing this strategy. If you only use one broker, then you're restricted to the financial products that that broker offers, which may or may not be the most competitive on the market. By using multiple brokers, you're widening the net of potential financial products that you can access. The reason why we're using Trading 212, Trade Republic, and DeGiro for this strategy is twofold. Firstly, with Trading 212 and Trade Republic, you'll pay 0 fees to execute this strategy, and with DeGiro, you'll only pay €1 for each investment. These are highly competitive rock bottom fees. Secondly, Trade Republic and DeGiro offer the most comprehensive selection of investments in Europe, and Trading 212 is a close second. By using all 3 brokers, you'll always have access to the best of the best at the lowest cost. So the first thing you'll want to do is get your account set up with each of these brokers. I'll leave the links to each broker in the video description. Simply click the links, download the apps for free, and create your accounts. It's as easy as that. Plus, you'll also be supporting me as a creator by using these links as opposed to manually searching for each of the apps in the App Store. Once you're set up with your brokers, it's time to move on to step 2. Step 2 is choosing your investments. The goal is to select investments that are both simplistic in that they require virtually zero time investment and proven in that historical returns support them as a long-term investment choice. For this strategy, we're exclusively investing in exchange-traded funds or ETFs, which offer exposure to the returns of particular stock market indices. These funds are known as index funds. funds. For example, an S&P 500 index fund will aim to provide its investors with the returns of the S&P 500 index. The S&P 500 index itself is a measurement tool which measures the stock performance of the top 500 companies in the United States. Each company within the index is given a weighting based on how valuable the company is relative to the index as a whole. So by investing in an S&P 500 index fund, you're really investing in companies like Apple, Microsoft, and Amazon. Most importantly, because you're simply buying and holding shares in a diversified fund which owns hundreds of companies, you're not having to make decisions about what stocks you should buy or sell, nor is the investment manager who is offering the fund. The fund simply owns companies in direct proportion to their relative weightings within the index. This is known as a passively managed investment strategy. The opposite of this is an actively managed strategy where buy and sell decisions about investments are made on an ongoing basis. This is a complex, time-consuming, and expensive process as compared to passive strategies. Plus, when we look at the data for investing over the long term, we know that actively managed investment strategies don't work, even for investing professionals. Over the past 15 years, 93.4% of actively managed large cap funds in the US underperformed the S&P 500 index. Over the past 10 years, 89.7% of European equity funds underperformed the S&P Europe 350 index. In both of these cases, the investment professionals managing these funds would have achieved better returns by simply mirroring the performance of the relevant index. Therefore, based on historical data, it's very likely that by investing in index funds over a long period of time, you're going to outperform the vast majority of investment professionals. But just how simplistic is index fund investing? Well, provided you're investing in index funds which track reputable, high quality, and diversified indices, then your time commitment will solely be limited to researching the best ETFs for gaining exposure to those indices. Once you have your ETF selected, that's it. You're done. No further research is required. Fortunately, I've done all of the hard work for you. In the description of this video, you'll find a Google spreadsheet which contains what are, in my opinion, the best ETFs for gaining exposure to the S&P 500, European equities, emerging market equities, and all world equities. I've provided ETFs for each category, including information such as the fund name, the ISIN, which is used to locate the ETFs on Trade Republic, Trading 212, and DeGiro, the total expense ratio, which is the annual cost of owning the ETFs, whether the ETFs accumulate or distribute their income, the structure of the ETFs, the brokerage platforms that the ETFs are available on, and a link to a video which contains more information about the ETF in question. If you want to learn more about how to research ETFs yourself, check out the video popping up on screen now. If I was in your position, I'd pick one S&P 500 ETF, one Europe ETF, and one emerging markets ETF, and I'd split my investments between each of these perhaps on a 40-40-20 basis. The exact split that you choose is entirely up to you. Personally, I don't invest in single all-world ETFs because I prefer owning multiple ETFs for different regions and having total control over how much money is allocated towards each region at a given point in time. All-world ETFs tend to be heavily weighted towards the US, so if you wanted to reduce your US exposure and increase your European and emerging markets exposure, this couldn't be done via one single all-world ETF. However, on the other hand, owning one single all-world ETF is the epitome of simplicity. It just comes down to personal preference. Step 3 is making your investments. Ideally, we want to spread our investments out across Trade Republic, Trading 212, and DeGiro for the reasons that we mentioned earlier. We also want to pay as little fees as possible. It is possible to execute our strategy while paying 0 fees on Trading 212 and Trade Republic and just €1 per transaction on DeGiro. In order to do this, each broker needs to be utilized in a slightly different manner. For Trading 212, provided the ETF shares that you're purchasing are quoted in euros, then you won't pay any fees for investing. For Trade Republic, you'll want to set up a savings plan which will automate your investments into your desired ETFs. You can check out the video popping up on screen after this one to learn how to set up a savings plan on Trade Republic. When a savings plan is used for investing on Trade Republic, there are no fees charged. For DeGiro, you'll need to ensure that the ETF is included in DeGiro's core ETF selection. You simply search for an ETF's ISIN in order to confirm this. If it is included, then each calendar month, the first investment in the ETF will be commission free regardless of the size of the investment. Only a €1 €1 handling fee will apply. Each subsequent investment in the ETF for that month will be liable to a €2 commission unless the investment is for at least €1,000. So using our list of ETFs, if you choose to invest in each of the iShares ETFs, then you'd pay 0 fees on Trading 212 and Trade Republic and only €1 per transaction on DeGiro. There is a case to be made for excluding DeGiro entirely and just using Trading 212 and Trade Republic. It just depends on how much diversification you want to have between brokers and what price you're willing to pay for that diversification. If all of the ETFs in your portfolio are included within DeGiro's core ETF selection, then you'll pay €36 worth of handling fees plus an exchange connectivity fee of €2.50 each year. That's assuming you make monthly investments into 3 different ETFs. However, if none of the ETFs are within the core ETF selection, then your annual fees will be €108 plus an exchange connectivity fee of €2.50. Clearly, that's a big difference. If we were to assume that we select each of the iShares ETFs for inclusion in our portfolio and that we have €600 available each month for investment, how would we go about investing it? We'd simply send €200 to each broker, search for our desired ETFs using the ETF's ISIN, and allocate the €200 investment between each of the 3 ETFs in accordance with our desired splits. That's it. We then rinse and repeat for decades. Obviously, things will change over time. We might increase the size of our investments, we might swap to a better ETF if one becomes available, and we might change our investment allocations. But what's most important is that we stay consistent, investing into the market each and every month. If you want to learn more about how to invest using each of these brokers, I'll leave my tutorial and review videos linked in the video description. So that's how I'd invest my first €100 as a European investor. This strategy is simplistic because it utilizes simple investment products. It's consistent because it revolves around monthly investments made over multiple decades, and it's knowledgeable because it's rooted in the data-proven fact that passive investment strategies outperform active investment strategies over the long term. It's also cost-effective both in terms of utilizing the cheapest ETFs on the market and in terms of minimizing the costs associated with using online brokerage platforms to invest. On top of all of that, this strategy requires virtually no time commitment, aside from topping up your brokerage platform each month, so you can spend more time doing the things that matter most to you. If you've made it this far in the video, then it's time to take the first step. Simply click the links in the video description, download each of the brokerage apps for free, create your accounts, and get started on your investing journey. Any questions, just leave them as a comment down below and I'll answer them. If you found this video to be useful, can I ask that you take just 2 seconds out of your day to show your support by leaving a like on the video, subscribing to the channel, and sharing the video with family and friends. Thanks very much for watching, and I'll see you soon.